Hi everyone, this is Abdullah with you. We're here to continue our series on how I pick stocks. We'll be going over a couple additional concepts today. In our prior video, we went over stock screener as well as price to book ratio. I know there have been some questions on price to book ratio, and we'll make sure to accumulate those questions and answer them in future videos. However, if you do have pressing questions, make sure to comment below the video and I'll make sure to get to those questions and be able to answer those. Today we're going to go over the current ratio and quick ratio. These two are able to give you a quick glimpse into the liquidity of the company and a quick glimpse into whether they're able to meet their short-term obligations. So for the current ratio, as we can see here, is a liquidity ratio that measures a company's ability to pay short-term obligations, and it's calculated by taking its current assets over its current liabilities. Question would be what's included in current assets and what's included in current liabilities. So for current assets, we have cash, short-term investments, we have prepaid, we have inventory, we have accounts receivable. For current liabilities, we have accounts payable, accrued liabilities, any payroll liabilities. In some cases, for manufacturing companies, you might have short-term warranty. And then also, depending on how the company recognizes revenue, you could have deferred revenue or revenue that they need to recognize in subsequent periods. For all of these assets and liabilities are basically less than a year. So these assets will come off the company's accounting records within a year. So that's why it gives you a good glimpse as far as their short-term obligations and the assets they have to be able to meet those short-term obligations. For the current ratio, it's a little bit more exclusive in that it excludes certain assets from the current asset calculation. Everybody has kind of a different definition here. It basically just says current assets minus inventories. In other cases, you might see where the current ratio only includes cash, investments, as well as accounts receivable, because those three items are the easiest to make liquid and turn into cash. Whereas with inventories, prepaids, and some other assets, it's very difficult to be able to make those liquid cash. So the quick ratio, even more so, is able to basically tell you if their cash is enough to be able to meet the obligations. There's different opinion on what the quick ratio should be. Obviously, if the higher the ratio, the better, meaning their assets are higher than their liabilities. Um, Generally, you want to look for companies with quick ratios and current ratios over one. In some cases, you might invest in other companies. Maybe you know certain fact pattern in the company. Maybe they're not able to meet their short-term obligations because they made a big purchase or an acquisition, so their cash would be a little light compared to what it should be. So maybe their long-term assets are a little bit higher because of that acquisition. So those are some things to consider. Here I have filtered for companies that have current ratios and quick ratios under one. And again, we want to look for things over one, but I just wanted to give a quick glimpse on a lot of companies that aren't currently able to meet their short-term obligations. So one of the things that we see recurring here are cruise liners, airline industry, a lot of capital intensive heavy businesses. These companies, obviously, especially airlines, oil, as well as cruise lines, they've been struggling and they haven't had an influx of cash coming in because people aren't booking cruises, people aren't booking as many flights, so their cash is a little bit short. So that's something to keep in mind, that these companies might be struggling in the short term, could very well rebound and be able to do well in the long term, but it's definitely something that you want to keep in mind when you're investing in companies, to be able to always look at their current ratios and quick ratios. So these are just a couple additional tools that you can put in your toolkit to be able to analyze companies and to make the right investments. Again, as always, make sure to subscribe and like the video, and put any questions you guys have in the comment section. Thanks everybody. Take care, and we'll see you guys next time. Bye.